Hi guys, thanks very much for your questions this quarter as usual. The Abbey Wealth questions seem to put me under pressure more than most, so I'm going to try my best to sort of record in this quick video a response to those questions. So we'll just fire ahead. First question is, will the AI, the artificial intelligence rally, continue to boost equity markets, or are we in a bubble? Good question. Okay, enthusiasm for AI has probably produced one of the narrowest market rallies or equity market rallies, certainly since I can remember. Now, what do I mean by a narrow equity market rally? Well, over 90% of the returns of the S&P 500 have actually been brought to us by just 7 companies, the magnificent 7 companies. So if you actually take the return of those companies out of the S&P 500, the S&P 500 is up just 3.8% this quarter, or this year I should say. You add those companies back in and the S&P 500 is up a staggering 16%. So it gives you an idea of the effect these companies are having on the overall market and how broad, or narrow I should say, the rally has been, just focusing on those 7 stocks. Those 7 stocks being, of course, Alphabet, which is Google, Amazon, Apple, Microsoft, Meta, which is Facebook, Tesla, Elon Musk's company, of course, and Nvidia, which you've probably all become familiar with simply due to the performance of Nvidia linked to AI this year. So it's been a really sort of narrow rally. Is this actually good? Well, look, there's growing concerns about the concentration of this rally, because essentially you want a broad market rally. That's the sort of the sweet spot really, and many strategists are now stating that actually if you're looking to raise your equity exposure, it's probably best to invest in good quality companies that are at a more reasonable valuation. And that's what we've done within the New Horizon strategy. So we have added to companies that we think, or we've targeted companies that have sort of more sort of attractive valuation metrics, companies often that pay higher dividends. Now, the frustrating thing about that this year is those companies in many instances are actually down. But over the long term, we still think having that diversification stands us instead. So of course we have the Nvidias and the 7 stocks that I mentioned. Of course we have the Nasdaq within the portfolio and the S&P 500. But we have diversified the portfolio, I would say, wider, which probably up until this point hasn't been the call. It's actually been putting all of your eggs in one basket, and that basket, of course, has been the tech basket this year. What does this actually mean moving forward, though? Having such a narrow rally, what often happens after such a narrow rally? Well, if you look at this chart here, and this has got a good point here to look at, market gains have historically been prevalent once stellar runs by the 5 largest stocks comes to an end. So if you look at this particular chart, we've got here the S&P 500 on average rises 6.7% after, or in the subsequent 6 months following such a narrow rally. So that's how we're positioned really. We are broadly diversified. We are diversified, including these tech stocks, but within stocks which have, if you like, more attractive valuations. And we're hoping towards the end of the year, and the second half of the year, which is what we said at Christmas time, you know, we thought that this year would be a tale of 2 halves, and we would start to see a more broader rally going into year end. So that's how we're positioned. I hope I've answered your question in as much as, do I think it's a bubble? I don't think it's a bubble. I think that the AI story will continue, but what we're focused on is the broader market giving us those healthy returns going into 2024. Okay, second question. Here we go. What is happening with the UK stock market? This probably is the most frustrating question, or seems like the most frustrating question we're receiving from advisors at the moment. That's because, of course, the performance of the FTSE 100, for example, this year has been pretty poor. The FTSE 100 this year is up around 0.5, 0.6%. So I'm going to try and paint you a picture. If you look at these charts, which should come up on your screen right now, it's all about inflation within the UK. UK inflation, or inflation in the UK, has proved much stickier than other developed world countries. Okay, so this particular chart on the left-hand side here, we've got inflation, which is coming at 8.7%. That's headline inflation. If you look at core inflation, that's coming at a 31-year high of 7.1%. These charts, of course, come from the great institution that is the BBC website. But with inflation being so stubborn or being so sticky, of course, this has provided, a worsening macroeconomic backdrop, which of course has made UK equities much more volatile. So if you listen to the Bank of England Governor Andrew Bailey, he's attributed sticky or sort of stubborn inflation to the tight jobs market, the labour market, which is what the Federal Reserve has been sort of discussing over the past 18 months within the US. He points to low unemployment levels, wage growth at 7.2% and over 1 million job vacancies. Now, what that means is that the futures market is now pricing in a further 100 basis point increase in interest rates before the end of the year. So that's 1% priced in before now or before the end of 2023. So that means that probably the central bank, the Bank of England, has one of the most challenging tasks to navigate out of all of the developed world markets. So with high inflation, high interest rates, or high and rising interest rates, and of course the potential now for this recession weighing on the economy, we've actually, within the New Horizon strategies, reduced our commercial property exposure. That's due to, of course, weak rental growth and, of course, hybrid, or the impact of hybrid working. As you can see, I'm working from home today. So we have reduced our commercial property exposure. We've maintained our distribution property exposure. What do I mean by that? Basically warehouses for the likes of online retailers, yielding now over 6%. We've maintained that exposure. But look, there's no doubt about it, the difficult macroeconomic backdrop has meant that UK equities will remain volatile. However, if you look at what analysts are stating, because of the potential value opportunity, the FTSE 100 is dominated by cyclical companies and they're trading at huge discounts. So like everything moves in cycles and moves in waves. So actually, the FTSE 100 now could start to offer value. The FTSE 100, for instance, is very light on technology stocks. What has rallied this year, as I covered in my first question, technology stocks, big tech. So, we've maintained within our strategies our large cap cyclical exposure. We think that's important, but within the UK, but we have started to trim our more small cap UK exposure, simply because the fears of a recession would be reflected or felt more within the small cap area of UK equities. Okay, third question. I actually said that I think the UK question was perhaps the most frustrating question for advisors because of the performance, but actually I disagree. Probably the most frustrating question we've had from you guys over the last sort of few months has been commodities, because we have a commodity holding within the portfolios, which is a broad commodity holding. We also have commodity exposure within the New Horizon Fund itself. The most frustrating question is now a good time to be holding commodities? Why are you holding commodities? Are conditions in place for a new commodity super cycle? So these are the questions we're getting. It's all around commodities. So I'm going to bring a few charts up here. Look, this first chart here is to talk about cycles. So it's long been accepted that commodity prices have tended to move in long cycles with extended waves of rising prices, followed by decades when prices have simply moved horizontal. So if we look at this particular chart, which dates back to 1990, prices have recently fallen on the easing of supply constraints and the anticipation of recession. But look, many analysts now believe that a base is being established before a long-term move higher. So that's really important. So wars, whether it's the world wars or whether, the war that we're currently experiencing in the Ukraine, they've tended to accompany upward waves. So big technological innovations have occurred within or when economies have been moving sideways and have not become more fully developed until prices or material prices have created some sort of urgency. So this is based on a 30-year cycle, this particular chart, which is from trough to peak to trough again. So what we're trying to point out with this particular chart is a new wave of outperformance might be upon us. Hence, we hold commodities. Now, we're not overweight commodities. We're not a commodity fund. We're talking sort of between 5 to 7% here. But compared to some peers, that can be quite high. And the commodity exposure that we have, of course, isn't just gold or precious metals. It, of course, includes industrial metals, base metals, soft commodities as well. So if we go to this next particular chart, or this table, if you like, the extent of outperformance in the first 15 years, so in the first half of a commodity cycle. Remember, we've just said the commodity cycle is usually 30 years. When you look at the outperformance comparing commodities to stocks, look at this particular table. It's huge, okay? It's quite considerable. This table has been brought to us by Sentiment Trader, by the way. So when advisors ask me, well, why are you holding commodities? Well, first and foremost, if we are at the start of a super cycle, this is where you want to be because the outperformance can be massive. It can be huge. Secondly, as much as anything else, is diversification. You know, whether you like commodities or not, you know, compared to equities, compared to bonds, okay, how commodities move is very different. Okay, and you've got to remember as well is inflation is still sticky across the globe, and you know conditions are favourable for strength in commodities, much like the 1970s. We've also had this sort of obviously the Russian invasion, which we've kind of got used to recently. Oh well, you know that's just going on in the background. But with you know the recent sort of the recent coup that the suggested coup in Russia to sort of Putin's power. What that has meant now is that with this sort of resistance towards Putin gaining prominence, the Russian president almost now needs to sort of demonstrate his global omnipotence, if you like. So that gives us further sort of feeling that there could be certain sort of, or more Russian turbulence as sort of Russian policies could yet provide sort of further instability in commodity markets. So that's something to be beware of course, which is why we still maintain gold. Within our property, or within our commodity exposure, I should say, we also, of course, have oil. Now, oil, of course, has performed really badly this year, but please bear in mind, look, a lot of the sort of risks that the oil price has managed to sort of to mitigate has been due to you know the US releasing barrels from the US Strategic Petroleum Reserve last year. Have a look at this particular chart here. This demonstrates, okay, that the US was ready for the last oil shock because guess what it did? As I say, it released barrels of oil. Well, look, that reserve now has been halved and is at the lowest level since 1982, the year of my birth, believe it or not. So the point that I'm making is that if there is another shock within the Russian invasion, or of course if we see OPEC cutting production as they have done, we don't have the US to be able to absorb or cushion that sort of shock, which of course would mitigate oil prices. So we are being quite conservative, we are being quite cautious. In many respects, we've been quite contrarian if you look at peers, because we have maintained commodity exposure, which hasn't been a good place to be in 2023, which is a great place to be in 2022, of course, but we maintain this as much as anything else for diversification. Continuing in the commodity, sort of on the commodity story, you know, I think it is really important to give you sort of background about the importance of the diversification. The New Horizon strategies seek broad diversification with a view to maximising risk-adjusted returns rather than sort of chasing momentum. So it can be quite frustrating at times when you think, well, why haven't we just sold out of this and jumped into something else? But of course, that can often introduce increased levels of volatility, which is what we want to avoid. That's really important. So if we look at this particular chart, okay, this demonstrates the waves, okay, between stocks and commodities. So essentially, stocks and bonds do best when commodity prices stay flat, which means the commodity exposure offers a really important component. We know that when commodities are flat for a long period, which is what we've experienced, over the last sort of decade, then stocks tend to rally. Conversely, when commodities have gained ground, such as within 2000 and the 1970s, then of course stocks have sort of been held back. Now, we want stocks to do well because of course we're overweight usually within the positions of the portfolios that we manage. Of course we do. But that's the important thing about having a diversified portfolio, to ensure that we do have other areas within the portfolio covered. And this is what this chart demonstrates really, really clearly, is when stocks rally, commodities do nothing. When commodities rally, stocks often reverse. So we want to have that key diversification. I know we're getting frustration over the Wisdom Tree product, which in many respects has been down. If you have that within the portfolio, that most of you will. That portfolio though, or that product, okay, is really good, the exchange traded fund, which gives exposure to over 22 commodities, including soft commodities, energy commodities, metals, including both industrial and precious metals, split broadly equally, okay? So it's a really good holding to give you diversified portfolio, give you diversified exposure across a range of commodity holdings, which, as I say, inflation, geopolitical background, and diversification as much as anything else means that we maintain our commodity exposure within the portfolios. Okay, so next question. What are the areas you're currently looking at, or which areas excite you the most moving forward? Good question. We've obviously touched upon the exuberance or the recent dominance of a handful of mega cap or US tech stocks, okay? What has started to happen is the small cap companies, which is what we're keeping an eye on. Small cap companies in the US have started to outperform their large cap or the large cap universe. Now that's after a period of underperformance. So take a quick look at this chart. This chart demonstrates the Russell 2000, which is a small cap index in the US, compared to the Russell large cap or mega cap index. Now over the long term, small cap, and this dates back to 99, so it's reasonably long term, but over the long term, small cap outperforms large cap. But of course there's additional volatility they have to take in consideration. But this has been difficult to believe over the last period, because of course mega cap has just done so well. Well, it seems that this trade is now beginning to turn, because the Fed's decision to push the pause button at the last Fed meeting, in which has been a really steeply rising interest rate cycle, this has now saw the Russell 2000 rebound. So in June, we saw a 6.6% rise in the Russell compared to the S&P 500, which is up around 2.9%. So the optimism within the small cap universe may, of course, now be warranted, because lots of the many valuations on these small cap stocks are way below the historical average, which gives them much more upside potential, which is again what this particular chart demonstrates. Again, these squiggly lines sometimes they can be quite confusing, but small caps in the US are now trading at around 14.4 times estimated 2023 earnings. You compare that to the S&P with the S&P's 19.5 times valuation. This is the largest valuation gap since the dot-com bubble, which points to small cap should give us some sort of rally, and we're starting to see that. So that's the area, as I talked about earlier, the diversification that we're looking to add to the portfolios, okay? Also, if there is a recovery within global markets, if we avoid that recession, which we believe, then of course small caps tend to outperform during a recovery, and may, of course, for years to come. They, of course, benefit from the creative destruction during difficult economic times, which has made them lean as they go into recovery. So what I mean by that is that a lot of these companies which have gone through a terrible recession, they're still standing. And if they're still standing, often there's less competition because the competitors have gone, of course, to the wall. So then that means in good times, when of course the economy starts to strengthen and come out of a recession, these small cap companies tend to outperform and do well. That's of course all dependent on the Fed engineering a soft landing. It's the first time I've used that term in this video, but that's of course that's determinant on economic conditions, which we believe will improve going into year end. And the final question, guys, what changes have you made to the New Horizon strategies this quarter? Obviously that is a similar question I get from you every quarter, and is covered in great depth within the quarterly report that you will receive over the next few days. I'll quickly go through them. First of all, in terms of increases, we've increased overall our equity exposure within the last quarter because of the general improvement within the global market itself. So increase of equity exposure. How have we increased our equity exposure? As I touched upon earlier, we've been looking for value. Now, we haven't been looking to chase returns within the sort of AI space, even though we still have exposure within the AI space. We have NASDAQ exposure. We've actually been looking for pockets of value. We increased overall, as I touched upon in the question earlier, our exposure to sort of US equity income, which in the short term has been a tough call, but that sort of value will stand us instead going into year end. So we increased our US equity income. We also increased our broad world equity income, our broad world equity exposure by around 2 or 3%. One of the calls, if you like, is we increased our S&P 500 exposure, but our SRI S&P 500 exposure. What that means is rather than just investing in the S&P 500 itself, we've gone for companies which are aligned to socially responsible investment criteria. And we increased that exposure by around 4%. We'll give you further colour on that within the report. We also increased our innovative tech as well, slightly, but again, that's more of a rebalance. Areas that we sort of reduced our precious metal exposure. So that kind of goes against what I've been talking about in terms of maintaining our commodity exposure, but this is something specific. We reduced the precious metal exposure and not the broader metal exposure or commodity exposure, but more focused on palladium and platinum. And the reason being, look, palladium and platinum have had a really tough year this year. That's mainly due to the sort of the shift or the momentum moving towards electric vehicles. Obviously, palladium and platinum are held within sort of catalytic converters and that sort of industry. So the momentum is against those sort of areas at the moment. You'll get fuller colour within the report, but again, that's an area or commodity that we have slightly reduced, but again, we're maintaining our overall commodity exposure, and that commodity exposure, of course, is still maintained within carbon credits. So again, I touched upon that in the last quarter. We've maintained our exposure to carbon credits as companies are becoming more green and look to offset their carbon emissions. Other areas we cut around 2% of our property exposure. Again, I alluded to why earlier, due to sort of the commercial property market struggling. So we have reduced that exposure, which has allowed us to increase our overall equity exposure. And also, as I touched upon within one of the questions earlier, depends whether you're tuning into this per question or you're going straight through the video itself. But we reduced our sort of small cap UK exposure, or small to mid cap, and that's simply because with recession or with the volatility going on in the marketplace in the UK, usually the smaller capped companies will bear the brunt of that should there be the recession, which is seemingly forecast with the struggles that the UK economy is going through at the moment. So hopefully that gives you an idea on what we're doing in the background. There's been lots of movements there, but again, I say refer back to the full report, which will give you further colour on exactly the sort of movements that you would have experienced within the overall portfolio in Q2 2023.